As an investor, I find one of the most important things we can do is pay attention to our weaknesses. And I believe that one of my weaknesses is the potential that inflation could continue to remain substantially more sticky than we believe. In this video, I'm actually going to provide you some perspective into how that could be the case. That is, inflation could remain high, and maybe the likes of Michael Burry will be correct, that inflation will be dragged down by certain temporary forces, and then unfortunately will rear its ugly head, leading the Federal Reserve to go from cut to hike again, yet substantially worse than the first time around. And positioning for this kind of pain is not ideal, but we'll talk about everything in this video. So let me first start by telling you that you're going to get some new insight from recent earnings calls in this video that give you a breakdown of why I'm making this video in the first place. But I'd like to start with the general thesis just to catch you up to speed. So the general thesis, I think we can pretty much all agree, as much as it's very difficult for everyone to agree, is that yes, inflation has been moderating for the last 40 years. It's been known as the Great Moderation. And yes, we all know that we substantially overinflated the economy in 2020 and 2021 with a substantial amount of inflationary stimulus, basically money printing. And it wasn't just the United States, it wasn't just Democrats or Republicans, it was everyone around the world. Now, the belief was that that sort of inflation would be transitory, which turned out not to be so great because, well, we had more variants of COVID, we had more supply chain issues than we expected, and we also ended up with a war in Ukraine, which is a big problem. All of these things are making transitory feel a whole lot more sticky. And yeah, maybe the best case scenario is that that inflation actually comes back down to trend or maybe even lower, and sort of that trend continues down. Then yeah, sure, if this ends up being the case, yeah, we might be able to sit around drinking beer together in 2030, looking back and going, remember when we had that transitory inflation? And you might reply, yeah, thank God it was transitory. But that's the bull scenario, right? What if we end up inflating, and as Michael Burry warns, yes, inflation is going to come down because we all know, we can all see it, the housing data is going to give us negative inflationary reads this year, specifically in the housing services sector, which could weigh down the entire sector, right? Well, as we weigh down the entire sector, yes, we're going to get negative reads. If that induces the Federal Reserve then to panic and flip-flop, so to speak, and then they start reducing rates, but then inflation pops back up, the Fed could potentially lose all credibility. And if you thought the break-even rates for inflation were a good thing, that they were, well, basically starting to trend down, you might be horribly surprised when those break-even yields for inflation end up skyrocketing because nobody actually believes the Federal Reserve can do their job anymore. The Federal Reserve's credibility is already substantially damaged from the initial claims that inflation would be transitory. And this right here, unfortunately, is just some bad news to reiterate the concerns. I'll hide myself in a moment, but this is the 5-year break-even chart. And even though yesterday and the day before, after some really low PPI numbers, this break-even chart plummeted to a new low this year, it's still, the entire chart, the lowest levels of this chart are still higher than in 2018. And if I remove myself, you'll actually see that the break-evens, while yes, they are volatile, have broken to the upside yet again. That is still relatively low. We're still on that downtrend, but they are breaking towards a higher level, not breaking down towards a lower level. This says that clearly, even though the broader bond market believes the Federal Reserve is going to start cutting rates at the end of the year, yes, we're going to see probably a pretty deep recession. I mean, it could, I shouldn't say deep. Yes, we're going to see a recession because of what the bond market is predicting, and we'll see those cuts. This break-even issue somewhat sends the signal that the bond market is also of the belief that yes, we could get cuts, yes, we could have the recession, but we might end up having to go back up. Because again, that entire chart is above the 2018 level. So there are definitely red flags in the economy. And generally when I go look to see, well, what's going on in the economy, and I look at earnings calls, I want to investigate which companies have pricing power and which companies are suffering from inflation. And unfortunately, we have a very, very large company that is now telling us a little about an inflation story that I didn't want to hear. Because so far, all of the earnings calls that I've been looking at have been of one consistent mindset. Price pressures are a lot lower. Things are inflating at a substantially lower rate or even deflating in certain cases. You've got companies like Winnebago, the RV manufacturer, who says, hey, you know what? If our competitors want to start cutting prices, well, we can do that too. You know what? We'll just all cut prices together and we'll have a price war to the downside. That's the RV market. Then you have a company like Tesla creating a price war in the vehicle market for electric vehicles. And since we know that companies like Ford, Lucid, and Rivian lose money for every vehicle they make, that's an electric vehicle, well, we expect them to lose now even more money or just leave the EV market, which in the case of Rivian or Lucid would be bankruptcy. In the case of BYD, might be going from a profit to negative if they end up following Tesla with this sort of pricing. And NIO and XPeng, well, we'll see what they end up doing. But so far, it looks like those price cuts are coming there as well. We've already seen some of them, more to potentially come. So you've got price wars in RVs, you've got price wars in cars. Where else are you potentially starting to see the rumor or murmuring of price wars? Well, I'm actually really happy to announce this one, but potentially the airlines. See, United Airlines in their last earnings call started talking about this idea that, hey, well, if our competitors start cutting airfares, we are prepared because we have gotten more efficient over the last few years. And even though we're still short 15% of pilots, and even though our revenues are still 15% lower than where they were in 2019, we can cut prices if we need to make sure we can stay competitive. And since we have better margins than the competitors, if they want to start cutting prices, we will too, and we'll win. Yeah, that is a paraphrase of literally what United said in their earnings call. Because again, I stick my head in these earnings calls and I'm like, oh, okay, I'm starting to see what's happening. However, all that was pointing to the same direction. Pricing wars, disinflation, deflation. Yes, okay, we know housing services are going to go negative. We know that wage inflation is slowing down, even though in 10 days on January 30th, we have the ECI release, which is the same day of the expiring coupon code for the lifetime access to the programs on Building Your Wealth. Of course, member live streams every day the market opens up, Q&A directly with me, but also a low price guarantee. The price won't be any lower. 3 months at least guaranteed, probably even longer since we tend to bump the prices over time. But what did we get today? And this was a little bit of the concerning one. Okay, here we go. So the earnings call we're about to look into is Procter & Gamble, and it creates some issues. So first of all, they talk a little bit about how they're making investments to make sure they have more supply. I want you to know that every company is saying this, almost every company, and this is actually disinflationary, right? The more you have companies saying, look, we have invested a lot to rejigger our supply chains to make sure we're never short of product again, the less inflationary pressures you should see the next time either China opens up or people go back to spending because we're coming out of a recession, right? The better supply chains are, the more they can absorb extra demand by basically just adding more supply. The problem with the COVID pandemic was as demand went up, we couldn't push up supply because certain factories in China, for example, were shut down or we were just never prepared for that level of demand in the first place. Well, now when we look at what Procter & Gamble tells us in the next pages, it actually should start making you nervous to the tune of what the Federal Reserve is saying. See, the Federal Reserve, like Mr. Waller, who's talking today, all of them, first of all, are on the same page. They're all like, we're going over 5. We're not going to cut rates this year. But you have Mr. Waller saying, hey, look, if inflation pops back up, we're just going to have to keep hiking rates. 25, 25, 20, 25, just keep going. This is obviously not being priced in by markets, so any kind of actual need to continue raising rates would end up forcing markets down, presumably. So what kind of red flags do we have that maybe inflation could stick around? Well, let me show you and then break it down. So take a look at this section right here. Thank you, John. As I've said in each guidance outlook for the past 2 years, we will undoubtedly experience more volatility in the fiscal year ahead. This rings true as we enter 2023. Okay, fine, volatility. But what did I highlight here? The combined year-on-year profit headwinds from foreign exchange rates, freight costs, materials, fuel, energy, and wage inflation are even a greater challenge in fiscal 2023 than they were in fiscal 2022. Now, this is a problem. First of all, it's worth noting that their fiscal calendar aligns with our actual calendar, for those of you who get concerned that maybe there's like a mismatch. Sometimes it's like we're in Q1 2023 and a company's talking about Q1 2024. It's so weird how some of these corporate calendars work. But this Procter & Gamble's actually aligns with the real calendar. So when they talk about 2023, they mean 2023. And they're telling you that they're expecting to face an even greater challenge from energy, wage inflation, materials, and freight costs today than they did last year. Now, I did find later in their earnings call that the way they handle contracts seems to imply that they might be rolling over contract rates that they had in 2021 to 2022 pricing, which of course we know that there was more inflation between 2021 and 2022, right? And if they have old contract rates, then maybe that's why they're experiencing this kind of pain. We'll go through this more in just a moment, but let me explain that for a moment here. If, let's say, Procter & Gamble, which does not hedge for inflation, but they do have contract rates, if you're in a situation where in 2020 inflation is here or prices are here, let's say, and then all of a sudden you go into 2021 and you have a pretty big price hike, so 2020 to 2021, big price hike, but you go into 2022 and you have an even bigger price hike, and then in 2023 you start seeing prices come down. Okay, great, that's roughly maybe what the overall market is seeing now. But there's a chance that what Procter & Gamble is actually warning of here is for their profit purposes, maybe they locked in contracts here at the end of 2021. And for much of 2022, the inflationary year, they were locked in at 2021 pricing. Maybe for their issues, they are now signing contracts based on where pricing is today, which is obviously higher than where it was now. Now, it's lower than last year, but it's still higher than 21. That is a possible explanation for this ugly warning they're giving us. But let's just be very, very clear here. Freight costs expected to be higher in 2023 compared with the average cost paid in 2022, given that, remember, not everything you can just contract out a year prior. I mean, it's one thing if you contract out plastics for a year, but usually freight is paid at the time, right? So it's kind of weird to see a company like Procter & Gamble, a huge consumer staples company, warn that we're seeing headwinds here. This is not good, that they're suggesting things could be worse now than in 2022. That's kind of remarkable. Let's try to get some more color on this though and go to the important parts. So they talk about reinvesting in productivity. Now, the more they talk about reinvesting in productivity, and every time they talk about pricing, they talk about productivity, you know what signal I glean? I glean a signal that what's actually happening to the company is they are losing some of their pricing power, their headline pricing power, and they're seeing their margins start getting squeezed. So in other words, they can only sell you that deodorant for $10, which is already ridiculously insane. And now they're starting to see people spend less money on $10 deodorant. At the same time, they're seeing costs maybe go from $6 to $7 for that deodorant. So they're getting squeezed at both ends. They're getting less volume, which means less overall profit, and less margin. So they're getting hit on both sides. That is basically the definition of no pricing power, right? Now, it is normal for in a recession people to demand fewer quantities of things. But if at the same time quantity demanded goes down, as your profit per unit goes down, now you really have virtually no pricing power. See, some companies with substantial pricing power can actually maintain prices or even slightly reduce prices as long as their margins remain substantially ahead of the competitors. And in doing so, they can cannibalize their competitors. And those price cuts become an investment into the future. Okay. For a staples company, though, this is a little harder to argue. It's not like we have network effects for deodorant. This is just people literally saying, I am going to make my deodorant last longer. Okay, maybe that's not the best example. But in their earnings call, they actually talk about this idea of their customers going and drawing down on their personal inventory more. Now, this is actually something I personally do. Usually, I like to buy like 4 deodorants at a time, and I stack them up in my in my vanity closet. And so that way, I know when I get to the last one, I'm like, oh, I don't have a backup anymore. I go reorder at that very moment. So that way, I always have a backup. I never run out of this stuff, right? Well, a lot of people do this. But what happens is, over time, you start accidentally buying too much. And so when the economy gets tight, what do people do? Well, they start looking through their stuff a little bit more and like, oh, look, I have more than I thought I had. Maybe I don't need to buy so early, or maybe instead of buying 4 at a time, I'm just gonna go buy 1 at a time because cash is tight right now. Right? That's a recession. Every business goes through pain in a recession. There is really no business that is like, yay, it's a recession. Some make the argument that lower or inferior goods will benefit in a recession, and this is an economic article or argument. It makes sense. Maybe dollar stores will see their pricing power go up, but usually what happens is, even though at a dollar store you might be able to get more top line revenue, your margins get destroyed, because what happens is people are going into the dollar store and they're not buying the water guns that cost 10 cents to make that they sell for $1. So you have this 90% gross profit. Instead, people go in and they start buying toothpaste for $1, which actually cost you 90 cents to acquire. So you're making more money on tiny margin things, right? So like, recessions suck for everyone, okay? So anyway, this said, this is a little bit of an issue. And what they're talking about is increasing their productivity and their advertising to try to maintain some of their pricing power, even though they're seeing a squeeze. So they talk about becoming more effective to try to increase their margins. This is good. We can end up seeing in their financials if they're successful at that. But they also talk about shifting more of their TV advertising spend to a lower cost per conversion digital ad. Now, moving from TV is bad for like a Time Warner Cable or Spectrum, right? To digital being good for YouTube, Snap, The Trade Desk, right? These are great plays when you see companies actually start looking at every dollar and going, where can we be more efficient? This is why I personally really like Trade Desk as an investment. Now, with that said, let's go through some of the other items here. They're talking about their productivity muscle because they need to offset the inflationary pressures they're facing. Yes. We see a private label reemergence. This is as expected in a recession. People are going from the Planters nuts to the Archer Farms nuts, even though they're probably all manufactured by the same company. It's a psychological trick. Here, look at this. This is where they make that argument. Consumers don't leave the category, but they might look at their dosing behaviors. This is not like steroid dosing. Okay, this is like having that backlog of like buying 4 deodorants versus 1, right? And then maybe now buying 1 instead of 4. Anyway, they might look a little bit closer at their inventories and draw that down over a period of time. Now, keep in mind, customers are not only retail customers, they're also wholesale customers. And that's probably what they're talking about with inventories, but it works for both sides. Behaviors happen at stores. So if you're a dollar store, you're like, look, do I really need 100 deodorants stocked, or should I just have 50 at a time? Same issue on both sides. Everybody does it in a recession. Very, very typical. Okay? So a Walmart indicated pricing pressure in general merchandise and apparel. This would be like toys, and then obviously clothing. Nobody is pleased about the current inflationary trends we're seeing. This is a concern to me. This is the first report that I've seen that's actually still complaining about inflation. Maybe we'll get more. And who knows? Again, maybe it's in part because their contracting sucks, and we'll dive into this a little bit more. I don't know, but it's bad. The reaction to those price increases from a retailer environment is what you would expect. Nobody is pleased about the continued inflationary trends we're seeing, but it remains a constructive discussion on how to best execute, which is recovery of inflationary cost. Now, keep in mind, when they talk about recovery of inflationary cost, they're not talking about raising pricing, because they can't raise pricing anymore. Instead, they have to try to become more efficient. But if you have not been trying to become efficient already, you're behind the curve, and this is not great. This is bad for Procter & Gamble. But the pricing we're taking is not covering the breadth of the price increases we're facing. In other words, we raised prices last year, but it ain't offsetting all the inflation we're seeing. We're seeing price increases on private label brands and on mid-tier offerings that are even in some cases higher than our own price increases. So this would be like comparing to competitors. In other words, they're seeing competitors either that have raised prices or are raising prices. That's not good. Obvious reason, which is yes, commodity prices have come down recently, and you might not feel those benefits immediately, but what's going on, says one analyst? Well, they say, look, about 63% of our problems are driven by commodities. Thankfully, yes, commodities have come down. But remember, on the commodity side, you have contracting, right? Again, like you're going to order plastics, you sign a contract for plastic manufacturing or plastic supply for your manufacturing over the next year at a set price, right? And maybe it has like an inflation adjuster in it of 3%, but then everybody's like, wow, inflation is 8%. I guess you guys won on that contract, right? Anyway, we've seen the majority of our commodity basket still increase week over week and month to month. This is a terrible red flag. Why? Why is Procter & Gamble seeing, yes, some decreases, but still seeing the majority of their commodities increase week over week? This right here is fuel to the fire of the Fed having to keep the boot on the back of our neck. As much as we're starting to see inflation come down, the fire is not out. There are still smoldering fires throughout this economy, which on one hand is great if you're trying to increase your allocation to stocks at low prices. You got plenty of time to do that. It's bad though if you're in the market and you're like, damn, prices keep going down, right? Now, look, we are off bottoms, right? But this is a red flag for maybe the market is being a little too optimistic trying to fight the Fed. This is why people say, don't fight the Fed. Okay? Anyway. So when you look at our overall commodity exposure, it is at this point in time stable to increasing. That's not good. And our assumption going forward is at spot rates that basically things stay flat is their assumption at this point. We don't hedge. We see slight increases week over week, month over month, certainly not to the tune we saw at the beginning of 2022. Okay, well, at the beginning of 2022, we saw like 8% increases in prices. Slight increases? Look, hey man, if we're seeing 1 to 3%, I'm game. It's fine. Because even if we get to 3% inflation, the Fed can flip-flop but just by saying, hey, we have fate, or we hit fate. Flexible average inflation targeting, FAIT. Anyway, that's going to be the way they back out of this. If I could like YOLO stock options on the Fed using the excuse to back out of this insanity we're experiencing by just saying, flexible average inflation targeting, it's good enough. We're close enough to 2%. I would put some good money on that bet because I think that's exactly what the Fed's going to do. But anyway, the interest rate differentials keep widening versus the United States, so we expect some headwind. Okay, this is on foreign exchange. That's fine. Transportation is rolling over. That's good. A little bit of easing over here. Great. But again, not everything has rolled over into contract rates, right? But maybe if we start getting contract rates at a lower level, you could actually see a tailwind. So they're feeding us some hopium. Or if you're already in the market, copium. See, if you're going to YOLO, it's hope. If you YOLO'd and lost, you're coping. Copium, hopium, they're both bad. Anyway, these are problems. These are not good. And there's a drawing of mine. And here's an unhighlighted page because there was nothing there that I found interesting. And here's another comment. On pricing, my answer is going to be quick. It's going to be a combination of pricing, productivity, and innovation. In other words, how they stay competitive. Let me be clear with you. I am calling their bluff. I do not think they have any ability to raise prices. I think they are going to try their best to advertise to their customers more, which is great for digital advertising, by trying to convince them that somehow their deodorant is more innovative than the next guy's. I would hate to be a staples manufacturer. I would also hate to manufacture staples, if you know what I mean, like deodorant or like paper staples. Those both seem really boring. Anyway, and productivity is like basically working your existing employees harder. If any of my employees are watching this, I love you, and you need to work harder. No, I'm just kidding. You guys do great. I love you guys. Keep it up. So this is bad. I don't like this report. Now, I'm going to caveat this, and I think this is why it's very important to stay to the end of the video, not so you can get every coupon pitch that I throw at you because the next expiration is January 30th, but because I have a little bit of a concern. What if Procter & Gamble is yapping about how, well, we're still seeing inflationary pressures as a way to excuse performance. Think about that for a moment. What if Procter & Gamble is actually starting to see some of the rollover, but it's not enough of a rollover, and they have to blame something, and they don't want to blame themselves, so what do? They blame inflation. After all, after this report, their stock kind of fell off the cliff a little bit. I mean, not that much. It's like 7%. It just looks like it fell off a cliff. And it's actually done pretty decently year over year. I mean, a year ago, the thing was at $147. Now it's at 142. Like, this isn't that big of a deal, which in part is because during recessions, people move into staples. But if you're actually looking at the real fundies, what if Procter & Gamble is blowing smoke? And they're like, yeah, we still got inflation. Damn, our numbers suck. But don't worry, when that inflation goes away, we'll do great. Quick, everybody, become more efficient in the factory. That's a jaded outlook. Okay, my opinion, summing this whole thing up, my opinion is reports like this are going to keep the Federal Reserve boot on our neck longer. They're going to keep us in the mud for longer. And it's our jobs to survive this and not die. Literally and figuratively, okay? We don't want either of those to happen. We don't want to die in markets. And IRL's kind of important too. So stay alive, obviously. A lot of pricing pressures are receding, but not everyone is seeing them yet. And because not everyone is seeing them yet, and there's still smoldering embers that could turn into wildfires, the Fed is probably going to be more aggressive for longer. Ironically, I don't think that's necessarily going to be terrible for the stock market. As long as we continue our trajectory down in inflation, I actually think it's going to be worse for the real estate market, because the more inflation smolders, the less people are going to buy bonds. The less people buy bonds, the higher yields go. And in an environment of quantitative tightening, which means basically higher yields, and people buying less bonds because maybe they want to yeet into stocks because those are starting to recover first, probably end up having more damage looking ahead to real estate than you do stocks. I know that's wild, but remember, when we look at an economy is not just one market. An economy is a combination of multiple different markets. This has been the oil market, and it's kind of doing this. Maybe it'll keep going down. The stock market has kind of done probably, as oil was rising, probably done something like that, like substantially higher of a start and some more pain, right? So there's sort of your oil market, there's your stock market, and the real estate market is, quite frankly, there. So it is entirely possible that, and this is just pure speculation at this point, that the oil market, it could go down, which would be fantastic. Oil market goes down, stock market booms, but because of quantitative tightening and a lack of bond buying, because people are more interested in stocks than bonds because bonds are still getting hit, partly because of quantitative tightening, the real estate market actually continues to trend down. That's my base case scenario. Oil down, real estate down, stocks up. And I believe in earnest that the stock market will bottom before the Federal Reserve actually U-turns, unless there's some kind of capitulation event. I believe that. But this right here from Procter & Gamble, bad news for inflation, and this is what I want to pay attention to. These are the kind of indicators that tell me, nope, way too soon to start YOLOing. Anyway, thank you so much for watching. I wish you the best out there. Good luck. Thanks for watching. Subscribe, share the video if you appreciated it, and we'll see you in the next one. Goodbye.